Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie, and today, the US economy, we're told, is going gangbusters. High growth, low unemployment, the Fed's set to continue with rate rises, probably a total of 4 this year, whilst Europe, well, not so good. Last week, Mario Draghi from the ECB said they won't be raising rates till late next year, a sign that they're seeing growth slow. So why the dichotomy between the two economies, and how long will it last? That's today on the Debunking Economics podcast. Well, Donald Trump forecast the US economic growth would reach 4% in his first year, and he wanted it to reach 6% in the near term. Well, the Atlanta Fed is now saying that their estimate for GDP in the second quarter of 2018 is going to be 4.8%. Others predict it's going to be around 3.7%, but in any case, that's well above the 2.2% annual growth in the first quarter. Manufacturing is picking up, unemployment is falling, and investors seem to be flocking there. The US Federal Reserve has just lifted interest rates for the second time, supposedly to keep the economy from overheating, and they plan to do it 2 more times this year. Compare that to Europe, where the ECB recently downgraded its forecasts and said it won't lift interest rates until the latter part of 2019, and that's got investors worried. Growth in Europe is around 2.5%. We're seeing the US dollar rise this year, whilst the euro is sliding, and the UK is doing worse. Growth is expected to be 1.3% this year, the slowest it's been since 2009. So, Steve, when one economy is doing so much better, as is the case in the US, isn't it a bit self-fulfilling? You know, if I'm an investor, I'm going to invest in the country that's doing well, which of course is going to help that country grow, and so it goes on.
That's one of those positive feedback things that was an essential part of Minsky's financial instability hypothesis. He said that when you have, if you have a crisis, in the aftermath of the crisis, everybody's conservative about investing, about borrowing money and so on, and everybody wants to have a large buffer in case things go wrong. And then, as it turns out, the economy actually is in a recovery phase. People are more willing to invest, so they actually have a higher desire to invest in capital goods, to establish new businesses, et cetera, which is all positive. They also have a higher desire to do that with borrowed money, which is positive initially, and then it can actually become overwhelming. So in that sense, America is well ahead, well ahead of where Europe has got to, because even though it's still got far too much private debt after the crisis than it had beforehand, it's back to the stage where that's growing, where Trump is throwing a major stimulus at the economy, possibly unintentionally, through the combination of not having cut spending as much and large tax cuts. So there's plenty of money boosting into the American economy and causing it to grow, and it's likely to grow above trend, which will be the first time it's done that in, I think, 11 years.
Well, I mean, a lot of people are saying actually this is before the impact of Donald Trump's tax cuts kick in, and of course also that he tried to repatriate profits as well back to the US as well, so companies had to bring their money back that might have sat overseas, so supposedly that gets invested in growth as well. So it's hard not to look at this though and say Donald Trump's had some part in this, even though perhaps it was inevitable. The Trumpster has obviously had some influence here. He has
had some influence, and it's partly because even though there hasn't passed all the tax cuts and so on, there's been, by the looks of it, a substantial increase in the American deficit. And the main thing is that they've recovered from the downturn that they had in credit. So credit is now positive again, not particularly positive, and there were good odds, like in terms of the scale. I think it's running at about 7% of GDP right now versus 15% before the crisis. Before the crisis actually hit -6 in its depth. But it's still positive. You're still getting an addition to demand, and you're getting that positive feedback effect that leads initially to growth and then to runaway debt, and then you got another little bit of fun on your hands.
Right, okay, so that's the follow-on. Well, before we get to that, let's look at what's happening right now. So presumably a lot of money is flowing to the United States right now. So, people are saying, yes, let's invest in the US. Money that might have gone to Europe or might have gone to emerging markets. People say, well, it's not worth taking the risk. Let's put the money in the United States. Are there any downsides for the US in that? That's surely all good upside, isn't it?
Well, it's got to have a rising dollar coming out of this, and that's actually going to be something which helps cause Donald Trump's favourite problem, which is imports being too high. So as the dollar increases in value, which it is doing right now, people have been selling down the euro, buying the American dollar as well. That makes it cheaper for Americans to buy imported goods. So it's a feedback which he won't like. But and a large part of, if you look at the country which is, to have two countries, one of which is running a deflationary policy, and let's call that country the European Union, just to choose a name at random, and the other one, America, running an expansionary policy, then what you will have is a leakage of the stimulus program from the stimulus running country, America, to the austerity running country, European Union, which will benefit the European Union. So there's one of the reasons that you can actually argue in favour of trade barriers or of something which restricts the purchasing of foreign goods, courtesy of a domestic stimulus.
And that's happening just because of the movement in currencies, you're saying. That's all.
It's also because, I think there's been a change in momentum of the economy as well, from people's willingness to borrow. As the economy recovers, as it had done under the crisis, there's a higher willingness to borrow, there's a higher willingness to invest, and it looks like it's actually going to drive America past the point where workers would normally be demanding wage rises through their unions, but they haven't got any unions because they've all effectively been either castrated or abolished. So at some point, I think it's going to get to the point where American employers are effectively screaming for workers by offering higher wages to attract them in. And I think we're going to see quite possibly a spike in inflation in America sometime in the near future. And that should be real fun, because I completely expect the Federal Reserve to totally misinterpret that and whack up rates quite heavily and cause a very sudden downturn.
Well, they're already saying 4 times this year. They've done it, they've done it twice. They're going to do it 2 more times. So you think they could start to say, well, this is getting serious now, we need to whack it up even more, and perhaps not going up 0.25%, go up 0.5% or more each time?
Don't think they're going to go for a 0.5% rise. I mean, they could well make that mistake. I wouldn't rule it out. But the 0.25% has become institutionalised ever since the level of private debt got to be as extreme as it was as around the 2000s, rather than making the sort of 1% move that Volcker made back in the inflationary 70s and 80s. They went down to 0.25%, and I don't think there's been anything more than a 0.25% move up for, 10, 20 years. No. There have been 1% moves down because, of course, they were completely sidelined by the financial crisis back in 2008. Once they realised what was actually happening, which is after the recession began, then they started cutting rates at about 1% per meeting for a while.
So what you're describing, though, where the situation where people start to go, well, it's not competitive now to make goods in the US largely because the flow of money into the US pushes up the value of the US dollar, so it becomes more cost effective, presumably, then for people to buy stuff from overseas rather than making it locally. That sort of sounds a bit like, the old invisible hand. It's, dealing with international competitiveness. It's sort of like finding its, dare I use the word, equilibrium, Steve.
No.
But I mean, it is the system trying to.
It's a system with a whole set of very complex feedbacks. And if you do have domestic stimulus and the economy is expanding, then you're going to have a potential for your currency to rise in value, because people will, again, the international speculators will be buying your dollar rather than buying a dollar of a country which is showing a negative trend. And bang, up go the rates, and up go the exchange rate, and therefore your competitiveness declines. So people are going to potentially buy more imports that way. So it's not equilibrium, it's feedback on a complex system.
So where does it all go from here? Does the Donald Trump approach mean that the US economy continues to grow at the expense of everybody else? Well, to hear, you'll have to listen to the podcast in full, and to do that, you'll have to become a subscriber. You can do that by choosing one of the subscription options on the right-hand side of the webpage at debunkingeconomics.com, or you can become a supporter of Steve Keen on Patreon. If you provide $10 or more support to all of his work on patreon.com, then you'll get access to this and all the other podcasts in this series. To do that, go to patreon.com/Prof Steve Keen. We hope to see you back here again soon to hear the full version of this podcast and all the others in this series. I'm Phil Dobbie. Thanks for listening.